Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is going to be the S&P 500 Index, the SPX. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On today's Stock Play of the Day, we're going to talk about a fairly advanced strategy that we've never really discussed before. We had, once again, a very odd day on the half day after Thanksgiving, in that we had the S&P 500 Index fall precipitously. And we did that on high volume. We had a lot of volume in the good old SPY, which is the ETF that tracks the S&P 500 index. So on high volume, we had a big down day. Actually, the volume was more than double on the half day on Friday relative to the beginning of the week, any day of the week overall. So very odd to see that situation. So right now, let's start by just showing my VIX watch list that we talk about almost every week on the Stock Play of the Day. We see that the VIX right now is at 28% implied volatility. We have the S&P 500 index down about 1.8%. So it's down, not as bad as it was on Friday overall. Obviously, the Delta variant that has been found and everybody is scared about has a lot to do with the markets in the downturn. We do also, the market's downturn overall, but we do also have some other economic news that is kind of lurking in the background, if you will, in that we still have the debt ceiling that has to be talked about. We have inflationary issues that are concerning overall. And because of the potential shutdown, I guess, and I'm using potential with air quotes, that people might perceive could happen because of the new variant. We had a lot of the pharmaceutical companies come out and say that we might need a new vaccine. Not quite sure where that came from because they're still studying the variant. They haven't been able to do a lot of research overall on it, but that has spooked the markets. Even more so in the VIX index than in the actual downturn of the S&P 500 index. The NASDAQ had a little bit of a pop-up. We had some stay-at-home stocks that did very well during the COVID period where we were actually work from home. Those stocks actually popped a little bit on the market. They're giving away a little bit of their strong move so far, but we still see the markets down. Overall, the NASDAQ has done a little bit better than the S&P 500 index. But what we're going to try to take advantage of today on the Stock Play of the Day, and as always, nothing's meant to be a recommendation when we talk about strategies here, but the fact that we see this big bump up in the VIX index overall means that advanced option strategies a lot of times will become cheaper. Stuff where we're selling we're selling a lot of premium relative to the time premium that we're buying. So let's look at the VIX, and that's going to be the focal point of the reason why I'm going to pick the strategy that we're going to look at today. Okay, so here's my VIX watch list. We see the actual VIX index up 5 or about 23% today. But if I look at the VIX chart over here on the right-hand side, we see that this is a range that we don't get to that often in the VIX. Since May, we've came up above the 2750 level. There's 3 times overall. Then prior to that, we just really have a tough time staying above 30 in the VIX index. So when that happens, we also see the option contracts that track the S&P 500 index and the VIX actual spot the VVIX, which is the VIX of the VIX. Now that's getting a little bit kind of a tongue twister there, but I'm going to pull up the VVIX index in my chart And you'll also see a huge spike up in the volatility that's inside the VIX option contracts. And we see that big spike up overall, which means that you're paying a lot if you're going to be trading VIX options. And the VIX is a different vehicle that is really for more advanced traders. I do talk a little bit about the VIX every once in a while in our weekly show and our midday market call overall. But today we're going to do something based off of the fact that we had the VVIX spike up that goes right along with the VIX, and we're going to be using S&P 500 index options. And oh, by the way, if you didn't know, the VIX actually is calculated from the prices inside the S&P 500 index options overall. So, makes sense that we would use the S&P 500 index options to try to capture some of the volatility premium, for lack of a better term, overall. And how we're going to do that is a little bit more advanced trade than what we usually talk about here on the Stock Play of the Day. What we're going to look at, and I'm going to run over to the options playbook, we have a long butterfly spread with puts. We're going to stick with a little bit of a downturn in the S&P 500 index, and we'll go look at the chart and kind of look at the area that we're going to target here. But we're mainly targeting it not necessarily because we think the market is going to go lower overall, but we can do this trade even if we wanted to be on the bull side of it for a very reasonable price, because when the volatility spikes, butterflies become cheap. And why is that? Well, you're selling two option contracts in a butterfly. This is, we're going to be bearish today. We're flipping a coin. We're thinking it could go a little bit lower. It has a little bit to do with the chart that we're going to look at here in just a second or two. But we're selling two option contracts that are at strike B here, which is going to be below the marketplace. So we're bringing in a lot of premium. We're also going to be buying strike C and strike A. They're all going to be out of the money. A lot of times with butterflies, at least inside the playbook, we bill it as a more neutral trade. But if you want to try to target an area outside or below the marketplace, you just use puts. You want to try to target an area above the marketplace, you just use calls overall. So we're going to be doing a put long butterfly spread today, and the VIX spiking up is going to make this a fairly inexpensive trade to do. We're going to need a decent move still to the downside, but we're not going to have a lot of risk overall on the total cost of the trade. So how are we going to do this? First of all, let's look at the chart. We mentioned in the chart that we're going to target an area. So I'm going to pull the S&P, the SPX chart down a little bit. Good news here is that we still have our ducks in a row. We still have the 200-day at the bottom. We have the 50-day above that, and we have the 20-day above that. This area was a big breakout area for the S&P 500 index. Once we broke out of that, we were setting new highs routinely, many days in a row in the S&P 500 index. So we're going to target that as an area of support. We had a big down day on Friday on very high volume. Maybe it continues. If it does, we're going to take an inexpensive speculative shot using a butterfly in the S&P 500 index, okay? So this area right here is right around, and the area that we're going to target in the butterfly is 45.45, mainly to keep on a strike price and make it very easy to remember. So the targeted area where we see a little bit of support in the chart as far as the S&P 500 index is where we had that breakout right here, which is 45.45. Okay, so let's go to the Ally Invest option chains, and we see we're still down about 80 points in the SPX. The one wonderful thing about the S&P 500 index is that there are many different expirations to choose from. Now, this is an index option, and if you've never traded index options, you want to look at the nuances of trading in an index versus trading in an actual stock. Index options are cash settled. That means that if you were to exercise an index call option, you don't buy all 500 stocks or thereabouts in the S&P 500 index. All that happens is there is the amount of cash, the difference between your strike price and where the index is at, determines the amount of cash that would be transferred into your account if you exercised a call option, or ideally if the market went down and you exercised the put options. It's cash settled, does not trade in shares of stock. These option contracts that we're going to look at have a very short-term expiration. We're only going to do it till this Friday, December 3rd, 3 days away. So you have 3 full days of trading. They stop trading on Friday after the close in the S&P 500 index. And we have a lot of different strike prices overall. Also, there's some tax consequences with trading index options. So just want to make you aware of that. You need to do your research before you would consider trading index options if you've only traded equity options in your lifetime. All right. So here's our trade. We have the S&P 500 index trading right now at almost right on the strike price of 4,470. We're going to go down to the 45.45 level, and that's going to be our option contract that we're selling. We're going to be selling 2 of those option contracts, and we're going to make this 15 points wide. You could go 20, I don't mind that, but if we go 15 points wide, that gives us about a 30-point landing area where this trade would be profitable by this Friday expiration. And I also want to highlight that if you were buying just a put option outright, with 3 days remaining to that expiration, we see that this option contract that we're focusing on, that we want the market to get down to, is trading for $41 overall. So that would be $4,100 just to buy one option contract. And a lot of that has to do with the fact that the VIX index has spiked and is trading up around that 28% level. So because of that, it makes all option contracts in the S&P 500 index fairly expensive relative to where they've been just last week. Okay, so here's our strategy workbench, and what we're doing is a 15-point wide butterfly. We're buying the 45.60, selling 2 of the 45.45s, and buying 1 of the 45.30s. Now, the midpoint in the S&P 500 index, they're very heavily traded. There's wide bid-ask spreads. It has a lot to do with the fact that it's an expensive underlying index, but the markets are pretty liquid overall. We're looking at about a 65-cent net debit. It's jumping all over the place. Let's call it 60. And that means that in this situation, we have a 15-point wide butterfly, and I'm putting it in the right rail over here, which makes it the official paper trade for the day. I'm going to try to target right at around 60. Now, if I'm working in the S&P 500 index and I'm looking at trying to execute a trade like this, we're doing it all as one trade. It's considered a 1x2x1 butterfly overall, so that's considered 1 unit. We're trying to get it done for a net debit of 60 cents to the account. That literally means our total risk here for every 1x2x1 butterfly, or every unit that we do, is going to be 60 times 100, or $60 plus commission on this trade. The upside of the trade is the width of the butterfly. It's 15 points wide. So there's about a 30 cents. You have a 15-point long call spread, or long put spread, I'm sorry, and a 15-point wide short put spread that make up that butterfly overall. That means you have about a 30-point landing area by this Friday that the S&P 500, the SPX could land in to make this trade profitable. So ideally, you would take the long put, and you would the 45.30, and you would add 60 cents to it, and the 45.60, and you'd subtract 60 cents to it, and that would be your break-even point. So if I'm entering this trade, I'm going to work the order because the midpoint is kind of tough to try to figure out when the market's moving this fast overall. So right now I'm showing a net debit of 60 cents to the account. I might start at 50 cents, might start at 55, see exactly where I'm at, but I'm just going to adjust it accordingly. If I'm trading in the S&P 500 index, I'm definitely going to work that order by entering limit orders in the marketplace. I never want to enter a market order in the S&P 500 index. I'd rather just not get filled as opposed to just entering a market order and let them fill me wherever they want to fill me at overall. Now, my experience in the SPX is that you can fill fairly close to a midpoint most of the time, especially with high volumes like we're seeing today, but that's never a guarantee. And don't forget, you got to always add commissions onto the trade. We're doing a three-legged trade here, so that's 4 contracts overall. Commissions will be a little bit higher than just buying an option outright in general. Okay, so that's the overview. Now I'm going to run down and look at the Ally Invest profit and loss graph, but I have to get rid of our right rail and our official trade. And I want to highlight here that if you look at this, because there's so much volatility and it's such a high price index, the colored line that goes through the middle of this trade is showing you that on the downside, we need some time decay. We've sold 2 option contracts. If we're correct on our forecast, those would be at the money option contracts. So I'm going to actually go all the way down to 0, and it's not going to move it too much because of everything that's involved. But as we get closer and closer to expiration, or implied volatility comes in and it goes down in price, you're eventually going to see this colored line morph into the dotted line, which shows you the maximum potential at that expiration date. This is part of the reason why we're only going out to December 3rd, that Friday expiration. There's so much premium in these option contracts overall that we're going short term and hoping that we will have that underlying stock come down towards our resistance level, which was, our support level, which was a resistance level to start with. And we're able to get it done fairly cheap. So not a high expectation here in that we're not hoping for a huge downturn. We're hoping that we drift lower over the next few days. We have a 30-point range within which the S&P 500 index could land in, and we could make it profitable on this trade. Now, if the market does continue down for the rest of the day and blows through our short strike, well, we should be up a little bit on that trade, and don't be scared to just get out of the trade. One of the things that would make me nervous is if we blew through the 45.45 level and we started going all the way down, before you know it, we're at 45.30, our long strike, which I'm highlighting here on the profit and loss chart. I don't want it to get that far. If it comes down and I put this trade on for 60 cents and I can sell it for $1, or I can sell it for $1.20, that's still a very, on a percentage basis, that's still a very good trade overall. So my nervousness on our forecast here would be that we would be right too soon on the trade, and we wouldn't get enough time decay or enough time premium to go away on our short option contracts to make this trade a little bit more profitable overall. All right, so obviously I'm all by myself today, but if you have questions, please put them in the chat box right now, and I will try to address them. Also want to let you know that I'm going to be doing a very big event today. At 2:30 Eastern Time, I'm going to kick off my rookies course on options. Now, it's going to be a very basic course. We're not going to be talking about butterflies in the rookies course. We're going to be going through the vernacular today and do the setup to talk about strategies later on. But it's going to be a 3-part series, and it's very simple. You go to ally.com/options for rookies, options with an S, rookies with an IES, and you can register and you'll get all the reminders for that event. You can obviously always just click subscribe and ring the bell. That will also send you a reminder about any events that we have here on the Ally YouTube channel. So if you're interested, please just hang out on the channel today at 2:30 p.m. Eastern time, and we'll be kicking off options for rookies. It's going to be a 45-minute event. It's going to be an interactive, interactive event. So please share with all your friends that might be interested in beginning option trading. Okay, so let me run over to the questions, see what we have today. Fairly advanced topic, so I'm assuming we'll have a few harder questions out there. Right now, I see William is saying, hi, everyone. Got a lot of highs. Hi, crazy market. I agree with that. Manny, hi, all. Chris. Everyone says trading options is so easy. I can't wrap my brain around it. Oh, my gosh, Chris, you just totally set me up for our rookies course on option. I appreciate that. So please show up at 2:30 and we'll talk a little bit about the basics of option trading. Brian, can you do this butterfly trade on Tesla? Yeah, you can. You can do it on Tesla. Like, I like the S&P 500 index a little bit better than Tesla. And this is a little bit of an oxymoron, and here's the reason why. Just overall, here's the reason why I'd rather be in the S&P 500 index with high volatility than Tesla, is you want some volatility with some predictability, right? In Tesla, the second half of that one's really tough, the predictability. We got the volatility, we got the high-priced underlying, which would ideally make the butterflies cheap in Tesla. It's not a bad way to take a position on it, but you need a little bit more predictability. You need a little bit more of a range that you think the underlying stock can land in. So S&P 500 index spikes up. I like to run the butterflies in the S&P 500 index because the fact that it's 500 stocks, the odds of you getting a 10% overnight spike in the S&P 500 index is a lot lower than in a stock like Tesla. I'm not saying it's not impossible. There's a chance, but a 2 or 5% spike in the S&P 500 index would be a huge overnight move, and in Tesla that would just be normal. So I want some volatility, some predictability. That's why we're talking about butterflies today in the S&P 500 index. All right. Zishan is saying, why did you choose an out of the money butterfly if we can go with an in the money butterfly? I guess it had something more to do with the chart that we looked at and the area and the momentum of the marketplace. The wider we go on our butterfly, the more expensive it's going to be. So by going a little bit out of the money, we made it a little bit cheaper. And we saw on the chart that we have an area where we might see the market slow down and kind of hang out, area of support on the downside. So that is the main reason why I chose the out of the money butterfly. One is, the first reason would be cost. It's going to be a little bit cheaper. And the second reason is we're just looking at the chart and we're just seeing an area, a defined area where the marketplace may go, hopefully, if we do the butterfly. But once again, not meant to be a recommendation. We're just trying to learn here. And that's what this show is all about. We're taking plays inside the options playbook, and we're grabbing those 40 different plays that you can see, and we're applying it to the current market conditions or to a current stock that we might be talking about today. Today, stock play of the day is really index play of the day, ideally, so we would have to change the name for one show overall. Chris says, I will be joining you at 2:30. Awesome, Chris. And please share with your friends. It's free for all. It's going to be a 3-part series. I haven't done this in a long time. I've been teaching options for about 30 years, and this is the first time in about 10 years that I've done an extremely basic options for rookies course. And we'll be doing it live on the Ally YouTube channel. Most of the times you would be within the Ally Invest site, but it's going to be free for all. And it will be recorded, so please share with friends and family after the fact too. All right, do we have a last call for questions? I have 2 minutes here, and if not, that's okay. Guess what? This Friday, we're going to do the stock play of the day overtime, and we're going to be able to see where this trade landed. So the risk is 60 cents on a down market, 1 by 2 by 1 butterfly. And this Friday, we'll know if the trade worked out. And if not, oh well, we lost our 60 cents on this trade. Now, this is one of those trades that you just don't want to over leverage it. We're only talking about it on a 1 by 2 by 1 basis. But the risk is minimal relative to the potential reward overall. So thanks for coming, everyone. Please click subscribe, ring the bell, and hopefully we'll see you at 2:30 p.m. Eastern Time on the Ally YouTube channel. Thanks for coming.